George. In today's video I'm going to talk about two very popular and safe investing strategies that have created many millionaires over the years. These strategies are dollar cost averaging and continuous investment. These strategies are different, however the investment system is the same. In this video I'm not telling you that you should apply this investment method because I don't know how's your financial situation right now. However, I do tell you that this is probably one of the most secure ways of buying financial instruments in a growing market. With respect to dollar cost averaging, it's for people that already have money. It's basically taking the money that you already have, such as $10,000, and investing the same amount of money systematically over a period of time, like $100. And this is regardless of the market price. Thereby, you diminish the risk of investing all the money in the wrong moment. However, since this channel is targeted to college students and you probably still don't have $10,000 to invest, continuous investment is more suitable for you. This strategy consists in saving a little bit of money every week or every month, and, as we do in dollar cost averaging, investing a little bit of money systematically in stocks, bonds, cryptocurrencies, ETFs, or any other financial instrument that suits your investment goals. This strategy is suitable for people that are investing and expect to see their assets appreciate in the long term. If what you do is more focused on scalping, swing trading, short-term investing, this method may not be for you. Let's now review the benefits of DCA and continuous investment. They can reduce the overall impact of price volatility and lower the average cost per share. By consistently investing over a long period, you benefit from the average cost of your purchases. This means that you are less reliant on trying to time the market and instead benefit from the long-term growth potential of the investments you hold. They also remove the pitfalls of market timing, such as buying only when prices have already risen. By investing a fixed amount regularly, you buy more shares when prices are low and fewer when prices are high. This helps smooth out the effects of market fluctuations over time and reduces the risk of making poor investment decisions based on short-term market movements. DCA and continuous investment also take emotions out of your investing and prevent you from potentially damaging your portfolio's return. Emotions like fear and greed can lead investors to make impulsive decisions that may not align with their long-term investment goals. Dollar cost averaging allows you to stick to a disciplined investment approach as you are committed to investing a fixed amount regardless of the market condition. Furthermore, they reinforce the practice of investing regularly to build wealth for the future. What I ended up understanding after reading and seeing all these investors' and entrepreneurs' lives is that building good financial habits is crucial for their success. Being patient and performing tasks that are going to benefit you in the future for a sustained period of time will lead you to where you want to be. However, remember that you should never invest money that you need. If you're going to invest, let it be with money that you don't mind losing and that you don't need. As you guys probably know, compound interest is like a snowball that keeps growing bigger and bigger over time. When you save or invest your money, compound interest is the extra money you earn on top of the original amount. Here's how it works. Let's say that you have $100 and you put it in a bank account that offers compound interest. The bank will pay you a certain percentage of interest on your initial $100. So if the interest rate is 5%, you will earn $5 in the first year. But here's where the magic happens. In the second year, instead of earning interest on your initial amount, you earn interest on the total amount of $105. And 5% of $105 is $5.25. So now you have $110.25 in the second year. As time goes on, this snowball effect continues. Each year, you earn interest not only on your initial amount, but also on the accumulated interest from previous years. This creates a compounding effect, and your money starts growing faster and faster. The longer you keep your money invested, the more impressive the growth becomes. Dollar cost averaging and continuous investment are particularly suitable for long-term investment goals, such as retirement or just to buy whatever you want in 20, 30 or 40 years from now. If you're going to invest, it's better if you do it as soon as you can, so you give your investments time to grow and potentially benefit from compounding returns. It's important to note that these strategies do not guarantee profits or protect against losses in a declining market. It's still crucial to conduct thorough research, diversify your investments, and consider your risk tolerance when implementing any investment strategy. Take into account that you can implement this strategy, but you are the one who chooses the financial instruments where you want to put your money to work. Consulting with a financial advisor can also provide personalized guidance based on your specific financial situation and goals. As I said, returns or losses will depend mainly on how much risk you want to take, that is, in which assets you invest the money and how much. Let's do an example where I apply this strategy and see future results. I could use penny stocks or other risky instrument that may have greater returns in the future, but let's stick with the yearly average return of the S&P 500 index over the last 50 years, which is 10%. So this is the compound interest calculator. With this machine, we can know how much money we're going to have in the future with the compound interest. So let's say that we haven't invested any money so far because we didn't have a job or we didn't know where to invest it or whatever. So here the value would be 0. The monthly contribution would be for example, $100 if we want to invest this money every month. The length in time in years, let's say that we want to know how much money we're going to have in 40 years. So imagine that we're 20 years old right now. We would know how much money we're going to have when we are 60 years old. The estimated interest rate, as we said before, the S&P 500 index gives you 10% of yearly average return. Then the interest rate variance range, let's put 3, so we know how much money we would have if the interest rate is 7% or 13%, and the compound frequency is annually. So here we see that in 40 years we will have more than $500,000, so that's a very nice amount. In this graph we can see how much money we would have during the 40 years and at the end, with a 7%, a 10% and a 13% of yearly average return. Remember that as soon as we keep earning more money in our job or with our investments, we're probably going to invest more than $100 every month, but in case we don't, this is the amount that we would have. If you're a person that has some experience trading, you might know what indicators are in a graph. I'm talking about the same strategies that I mentioned before, DCA and continuous investment, but now getting a better entrance point when investing your weekly or monthly amount. What I'm talking about is called a moving average indicator. This could be something that you might be interested in if you like looking at graphs or doing more detailed research to know how much money to invest every time. For example, here we have a 50-day moving average, the purple line. This is the average price of the stock in the last 50 days. This value is updated every day and considers the last 50 days. That's why the value changes. You also have 100 or 200 days moving average that, by the way, are used a lot by long-term investors. What many people do when they are using the DCA strategy is invest a little bit more money when the price is under the average and invest a little bit less money when the price is above. For example, if you're investing $100 a month and the price is above the average, invest $80 or $90 rather than $100. On the other hand, if the price is below the average, you could invest $110 or $120. This way, you will have high returns in the future. If you guys want to learn more about personal finance and growth, please subscribe and like the video. If you want me to talk about something specific that you like, just write it in the comments below, and as always, see you in the next video.